name is Udara Peiris. I'm an associate professor of finance at ICEF, and my research involves the intersection of macroeconomics and finance, and in particular, I deal with issues to do with financial stability, macroprudential policy, and monetary policy. So basically, how the main policy and regulatory tools impact upon the financial markets and the real economy. You can see my email address here. So feel free to send me emails about either the content of my talk or about the master's program. Okay. So let's get started. As you all probably know, as of 2021, COVID has had a huge impact in terms of human lives, hospitalizations, and the impact on the healthcare system around the world. And this crisis also created, I say, unprecedented stress, even though it's not necessarily unprecedented. It's unprecedented in the sense for many people who are born sort of after World War II, it is definitely unprecedented. And new financial risks. So over the last 20, 30 years, there's been several major global financial crises. In the 70s, there was the crisis to do with the price of oil, and there was a recession associated with this and inflation. Late 80s, there was a stock market crash all over the world, which was triggered, or at least triggered the decline in Japan's growth miracle. In the 90s, there was the Asian financial crisis. Then 2007, the global financial crisis. All these crises, essentially financial crisis. So the basis of that was overvaluation of financial assets, inappropriate levels of leverage, and the market was essentially correcting itself. What we have here is closer to what perhaps people in certain countries have experienced. It's the cost to the economy of severe disruptions in real economic activity. Globally, we haven't seen anything since World War II like this. So you can see the analogy I'm really making is that the impact on the economies has parallels, at least, to what happens during times of war. During times of war, you just can't operate your economy in the same way. There's disruptions in the supply chain, there's disruptions in labor, and especially the movement of labor. Now, in that sense, this crisis is very different to these previous major crises that we faced since World War II. And so the remedies need to be different. Whereas before, in a financial crisis, you need to address inefficiencies, mispricing, and externalities coming from the financial sector. Here, what is more important is how to stimulate the real side of the economy, how to get investment restarted. And there isn't really a significant problem in the financial sector itself. All right, so just to kind of frame the way, at least I'm thinking about it, this is really a situation following maybe a war where policy has to stimulate real economic activity. If you have any questions as I go along, you can just unmute yourself and ask me. I think it'll be more useful than waiting till the end, and I have to just manage the time, but pretty much the way I conduct my lectures at ICEF is also one where people are free to ask questions throughout. So if you have anything, just unmute yourself and ask. I think you all have the ability to do that. If you don't, just send a message or something. All right. So this is US unemployment, initial jobless claims, weekly unemployment claims in the US. You can see it reached 6.9 million, which really hasn't been since in the US, I think, since the 1920s, this sort of rise. And you can see even up to now, it's significantly higher than what was seen in the previous couple of years. The UK suffered the biggest economic contraction in 3 centuries, in 300 years. So you can see it fell, I think overall it was around 20% decline in GDP in the UK. So here is 10% in, I don't know what this period is, but I think, yeah. So this is from the level of GDP. Annual change was 10%. So you can see the magnitude of these numbers is very large. On the one hand, on the other hand, they're not as large as that they seem, because much of the GDP that has fallen is to do with industries that are sort of service-based. For example, restaurants are kind of the most obvious example, or cinemas. When they close, that's a cut in GDP. However, it's not a necessary restriction on economic life. It just means that people are employed, but it's not like it has a vast, significant impact on the whole economy. What the big fear that we had when the crisis started was that there would be supply chain disruptions, particularly with food. I mean, reports came out pretty quickly saying that the food supply chain is pretty much okay. And this was turned out to be the case in Russia and the rest of the world. And I think that's sort of that and energy were the two things that really needed to continue, and they did, which meant that the disruption wasn't as severe as it could be. Okay. So the economic numbers are not as bad as they would seem in the, just look at the numbers naively, but they're still really quite significant when you look at overall investment in the economy. GDP growth continues to fall. So this is Q4 numbers. Italy minus 6.6 year-on-year growth. And the only one outstanding here is China, which has grown off the back of an increase in exports again to the rest of the world. The economic problems around the world have been sort of compensated or managed to an extent by a large increase in debt and leverage. So firstly, the government has had to spend a lot more in supplying additional healthcare necessities. But also they have been involved in policies to support the economy at a time where fiscal revenue, taxation revenue has fallen. At the same time, there's been an increase in debt of non-financial corporates. So these are like standard firms, and that's this block here. So if you look in Canada, Japan, US, Eurozone, these numbers are quite significant. So you should see basically this increase in government debt to be supporting both households and non-financial corporates. But overall, there's been an increase in debt. Again, it's somewhat unprecedented. It's significantly higher than the numbers we experienced during the global financial crisis. At the same time, there's been an increase in, or there's a concern that there would be an increase in default rates. This is a historical graph of unemployment in the US with credit card write-offs, so default on credit cards. So you can see in the financial crisis, when unemployment rose, credit card debt defaults rose. And this numbers went down as the unemployment number went down. It's intuitive. People borrow on credit cards. If they're unemployed, they have to default. At a larger scale, this is a concern to the banking system. The banking system is being encouraged and in some ways pushed to lend, especially to companies. But these companies are borrowing at a time where it's extremely difficult for them to operate, which makes the loans that they're giving extremely risky, which means that the loans or the assets of the banking system are also have a lot of risk. So I'll touch on how some of these policies, what some of the policies that the government has implemented to try and relieve this. But if you look at, if we go back to public debt, so government debt, as I said, these have been really historically large jumps. So the UK went from around 80% to over 100% within a year. That's a tremendous amount of increase in government debt to GDP. So we're in a stage where the government has issued debt. Who is holding this debt? It's the banking system. At the same time, the banking system is being encouraged to lend to firms. And so we have to think very hard of what is happening to financial stability of the banking system. As sort of a side note, this sort of increase in government debt is concerning because when banks own a lot of government debt on their balance sheets as a fraction of their total assets, the banks tend to become very passive because they can, without doing much, just collect the interest payments of government debt. It's risk-free returns. The interest rates are low, but essentially for doing nothing, they pick up interest. And also they don't really have much additional capital to extend further loans to the private sector. When you look at UK data, during World War II, the government issued a lot of debt, which the banking sector held. And this proportion of government debt was only really paid off in the 80s. And after this debt started to get paid off significantly or enough in the 80s, that's when the UK banking system started to really pick up. It's because the banks now had additional capital, cash on their balance sheets, which they could lend out. They had additional capacity. So the financial boom in the UK from the early 80s until, I guess, 2010 was really on the back of the banks having this capacity. So the medium-term risks to growth, I think, are these sorts of numbers, whether this is going to hinder the ability of the banking system to extend credit going forward for the next 20, 30 years. So we could be in a situation where we can get over this crisis, things are not so bad, like GDP recovers, but we could be like Japan, which has basically had zero growth since the early 90s. So it's been 30 years, Japan has had, very low, if not zero growth. And we could be in this situation. Again, the Japanese banks have a huge amount of government debt on their balance sheets. So that's an issue which hasn't really been discussed too much right now, just because there are first order problems of just sort of getting the economy back on track. But I think this is an issue which will really come back again. Before the crisis, there was an issue of that was discussed called secular stagnation. And that was the argument that the world economy is in such a stage where it's not possible for it to grow any faster. And so secular here meaning sort of permanent, structural. So this sort of issue may re-emerge now after the crisis, but with a sort of a different spin on it. Okay, emerging markets, if you turn to them, there's a huge amount of capital outflow initially after the crisis. But what we have seen in the last sort of 6 months is that there were strong flows back into emerging markets. Part of this is that US interest rates fell, and plus there was increased risks now recently to do with inflation in the US. And emerging markets have proven to be much more resilient than was initially feared. Also, banks are now in a much better position than they were in the global financial crisis. So this is the ratio of risk-weighted assets to Tier 1 capital. Tier 1 capital. So the, sorry, it's the other way around. Tier 1 capital to risk-weighted assets. So the higher the number, the higher this number, it means that the banks are much more solvent and able to absorb losses. Also, household leverage is another source of concern. These are a bunch of countries: Australia, UK, New Zealand, Canada, US, and the Euro area. And we can see in 2007, household debt really reached a historical peak. Following this period, household debt mostly stayed constant, but there was a steady rise up from around 2015-16 onwards. I don't know the exact numbers now, but I do know household debt has gone up even further. So this is also a further source of risk to the economy. In general, studies have shown that household debt, and particularly household deleveraging, which means when households become indebted and start defaulting, is a major source of risk to creating a financial and economic crisis. There's an argument out there that the economic contraction we saw in 2007-8 was really because of this household leverage. Okay. So just to sort of summarize the difference between 2008 and 20, in 2008, it was the fall in house prices plus the level of household indebtedness that caused a decline in banking net worth because banks, people were defaulting on their loans to banks, plus the low capitalization of the banks caused banks to constrain or contract their balance sheets, which affected lending and the supply of credit. And that was kind of the feedback into the economy. But the key thing, it started from household indebtedness and from demand. In 2020, the current problem is somewhat different because it's really from the production side, the fact that firms are not allowed to produce. Because firms can't produce, they can't pay workers, which reduces household income. Reducing household income reduces aggregate demand. Aggregate demand then, reduction aggregate demand also reduces aggregate income, which increases NPL. So NPL stands for non-performing loans. Non-performing loans, so that's a key term in the banking system. And the response has been an increase in fiscal policy. So whereas in 2020, it was essentially an increase in money and liquidity, which policy was focusing on, now it's essentially fiscal policy, government debt, which has stepped in. Of course, there's been an increase in liquidity, but the emphasis has been really on fiscal activities to stimulate aggregate demand and aggregate income. Do you have any questions for the first part of the talk? Okay, if you look at, so I'm not going to now move on to policy responses. the US has really put in a large amount of fiscal stimulus. And I think this was before Biden became president. And I think Biden's fiscal stimulus is significantly higher than even this. So if you look at as a percentage of nominal GDP, it's around 10% in the US, and in Europe, it's around 8%. Sorry, about 6%. So the US has been much more aggressive in using fiscal policy, and a lot of this has been to do with direct transfers to a household, tax breaks to firms, and other forms of direct support to support indebtedness in the economy. So the US acted really quite aggressively in this. Plus, as I said, they did use money supply. And in fact, the surge in money supply was the largest in 150 years. So this is the increase in M2 in the US. So the blue line is money supply, the pink is inflation. And you can see compared to 2008, which was around here, I think, you can see that this is much significantly even larger than that. The general mix of policies that were used, this is for all over the world. Green means monetary policy. Yellow is macroprudential policy. Red is fiscal policy, and blue is emergency liquidity. This is 2020, and you can see that from March onwards, there has been basically a mix where initially there was a lot of monetary policy. And here it was macroprudential policy, which was sustained. Macroprudential and fiscal policy ended up being what is more of the long-term use. So in the beginning, it was monetary policy and emergency liquidity, and these shares declined. And the emphasis is really on fiscal policy and macroprudential policy. I haven't got data past this point, but I can speak a little bit about the sorts of macroprudential policies that were used. In the euro area, banks were allowed to use various micro and macroprudential capital buffers. So as you may know, all banks in the world have to meet a certain capital ratio, which is the ratio of their capital to risk-weighted assets. And that number should be around somewhere between around 12%, depending on whether it's a big bank and what regime it's in. After the crisis, this number was allowed to go down temporarily, which acknowledged the fact that the value of equity in banks has declined, but also to give space for banks on their balance sheets to extend further loans. Yeah, so you see that there was a much more discretion available for banks to be able to adjust the amount of capital on their balance sheets and still adhere to regulatory ratios. There was also certain changes into the supervisory and regulatory regime. There's more flexibility in the classification of loans that were unlikely to pay. So you didn't have to, there are a lot of sort of accounting nuances when it comes to banking regulation. One of these is like when you should acknowledge that a firm can't repay its loan. So if the bank can defer when the loans are classified as non-performing, then they don't need to acknowledge the loss on their balance sheets, which means the value of the equity doesn't fall. Okay, so it's an accounting trick, but it's a useful accounting trick which removes the need for banks to start going out to the markets and raising more equity at a time where it's very expensive and difficult to do this. Banks were recommended not to pay dividends. However, many banks did continue to pay out dividends during the end of 2020. I haven't got the chart here, but there's plenty of evidence that, especially in the US, the major banks continued to pay dividends, which is not really great because they were receiving a lot of subsidized loans from the central bank and essentially profiting from this. But at the same time, their shareholders were still receiving payouts on their dividends. Okay, so the yeah, there was also a postponement on stress tests for the banks. So stress tests are regular tests which are done by the regulator, which test how the banks would perform if there was a negative shock that occurred. By not doing this or postponing this allows the banks to focus on lending, but it also means that they don't need to worry so much about how to kind of cover themselves in order to satisfy these requirements. So on the one hand, we don't want the banks to fail. But on the other hand, we also don't want the banks to worry too much about meeting regulatory requirements. So the way this is essentially working is that the banks are getting a lot of state support with the idea that the state support is going to be then used to on-lend to the rest of the economy. This is some of the policies that the EU has announced. So there's pandemic crisis support of 540 billion euros, multi-annual financial framework, 1.1 billion. Most of these numbers are essentially much too small for the European economy. Now, there are two other kind of major tools which are used. One is direct lending, grants or concessionary loans from the state, either to banks or to the private sector, which has been used extensively. The second is what is called public guarantee schemes. So public guarantee schemes basically say that if a bank lends to a firm, of course, which firm and what type of loan is pre-specified, but the state will cover 80% of any losses to the bank from that loan. So this has proven to be quite successful in the countries that have implemented, which is most of the major ones. But it's still not worked out exactly what the ultimate implication of this is for the economy and most importantly for government debt, because essentially what you're doing is introducing a contingent liability to government debt at a time when we saw before that government debt is already at historically high numbers. So to summarize, we're in interesting times, as the Chinese proverb goes. But in a sense, it's also times which are comparable to what the world has gone through in the past. We're at a time where we're going to emerge out of this almost surely without any major structural changes to the economy. But we're going to emerge out of this with a huge amount of government debt and possibly a large amount of indebtedness of firms. So the major fears that are being discussed is number one, inflation risks. And in fact, I had a chart here somewhere, but in the US, there has been an increasing pricing in of inflation expectations. So the yield curve has steepened, and if you take the spread between TIPS, which is Treasury inflation protected securities, and nominal bonds, this gives us an inflation premium. So the expected inflation in the US has increased a lot. Secondly is debt sustainability. And in a sense, these are connected. And the third is financial stability. What is the risks? What are the risks on the balance sheets of banks? And how will this affect the ability of banks to further extend loans in the medium term? So we've gone through kind of the initial painful phase, but the medium term effects may actually be more significant when you sort of compound it than the crash that we've seen in the last year.